This is the Real Estate Investing Abundance Podcast. I'm your host, Dr. Allen. I know you're excited to get into today's show, but I have a very exciting announcement to share with you before moving to the show. We've just launched a complimentary and comprehensive webinar that, among other things, shows you how to legally use passive real estate investing to reduce your taxes, recession-proof your nest egg, and take the sting out of inflation. If you are curious to learn more, go to stevetucker.com/webinar. It is complimentary and only takes a couple of minutes of your time. Once again, that is stevetucker.com/webinar. I'll see you in the webinar. Enjoy today's show. Hello, enlightened investors. This is the Real Estate Investing Abundance Podcast, and I'm your host, Dr. Allen Lomax. And I am so glad you are with us today. We are going to delve in to what it means to be a true passive real estate investor. And with us is Dave VanHorn, and he is the founder and executive chairman of PPR Capital Management, a holding company that manages several funds which buy and sell both residential mortgages and commercial real estate nationwide. So, Dave, take us into the show and share a moment that was key to you, to who you are today.
Wow, there's so many. Thanks, Dr. Allen. I guess I know a pivotal moment for me was early on in my career. I was a contractor and I was also a realtor, and I had a missing component, and it was capital. And I remember I was taking a night course on real estate investing, and I was working towards my broker's license at the time. And I remember the teacher saying, "How many people in here have credit cards?" And we all raised our hand. And he said, "How many of these are buying homes with credit cards?" And all the hands went down. And I remember going home and telling my wife that I think we're going to buy a house with credit card. And really what I was missing was capital. And, obviously real estate investing is a capital intensive business. And even years later, I had a coach and mentor who would always ask me the same question, which was, what is the one thing that you can leverage in the next 6 to 12 months that'll catapult your business or your personal life? And, it really got me. That word leverage was key. And that's kind of what my missing link was, even though I didn't know it years earlier as a contractor. But that was kind of the missing link. I didn't have a lot of capital. I was a blue collar kid growing up, and I was fortunate, but I didn't have all the pieces, and I was missing the capital piece. And once I figured that out, I actually started acquiring a bunch of properties, and then eventually, I would use other types of capital to help acquire, fix them up, refinance them. And then eventually the portfolio I had gotten up to about 40 units. And, the values jumped up in value, and you'd pay down the mortgage and things like that. And next thing you know, I had a couple $1 million in equity, and then I became more of a lender. So I started out, as a private lender for fellow contractors, that kind of thing. And then that blossomed later on into institutional mortgages and notes that led into the funds we manage today, which right now we're a private equity firm that invests, like you said, primarily in mortgages and commercial real estate. And we're around $300 million in private equity. Give you a scope. We have 32 employees. But we're fast. I guess we're just under 700 million in assets, but 75% of our assets are in the mortgage side of the business. So it's a little different than, a syndication or a commercial real estate fund where, all the assets are in commercial real estate. And it's a little bit different there because we don't necessarily have the same leverage that you would have, say, in the commercial real estate components. Yeah.
Well, you have recently transitioned to executive chair, and what exactly is your role as executive chairman, and how was that transitional process?
Well, it's a very interesting process. Really, if you think about it, it's going from I kind of did it both places. On my personal life, I went from being a really active, hands-on investor, being more of a passive investor. So, for example, personally, most of my investments, I do a lot of multifamily investing, a lot of alternative investing, and really I'm in a K1 world these days, as opposed to being hands-on. And a lot of that I did to, for my wife and my kids at this point in my life. I didn't want to leave them a lot of active things to do. And then same way on the business side, as I was getting older and up in years, you work those 80, 90-hour weeks that can get old after a while. But I was fortunate. We actually started the process a couple of years ago. I had a couple different coaches. One coach was a gentleman who had flipped hundreds of businesses, and he did a lot of M&A work, and he coached us up on some of the things we needed to do for succession planning with not just me, with the entire executive C-suite team, to start to think about more redundancy in the business. I have two partners, for example. One partner is like the same in age as me, pretty much, and that kind of thing. And we had a couple of members of our C-suite that were in their 60s. So I think it's prudent to be proactive. I don't think you want to be, like the TV show Succession or something where you fail to plan kind of thing. So it was a couple-year process. We did end up hiring a search firm. That took a while. And then we, interviewed candidates, and then we finally selected the CEO that we have today, which so far, everything's working out pretty well. He has a really strong background. He worked at SEI. SEI had 1.3 trillion of assets under management. So it came from a much larger firm, but he had been there a long time, like 29 years. So he really scaled that business. So back to your question about executive chairman, I guess the difference between an executive chairman and a chairman is that the executive chairman is working in the business a little bit, continues to work in the business on some level. And what I did was I really focused on what I'm best at, which was more on the investor relations side, the capital side, the marketing side of things. So I still assist those teams that we have, which has actually helped the transition dramatically. And it was kind of, me sitting down with myself going, I read a bunch of books from Dan Sullivan, for example, Who Not How and The Gap and the Gain. And now the new one that's out, it's 10X is easier than 2X, right? But the thing that did it for me was the 80-20 rule. And I started looking at my own personal schedule, for example. And I literally took my Outlook calendar for literally the year. I went month by month and said, what am I doing? How am I spending my days? And then I broke it into 3 columns. And I said, what do I love to do? I get energy from. It doesn't feel like work. I'd probably do it for free, kind of thing. And then I had this column over here. I hate to do this. Why am I in this meeting? Why am I doing these activities I don't like? But the trickiest column actually is the middle column, where there's things that you can, you're good at them, but should you be doing them? So, today, obviously, was previously a fund manager and CEO for the last 15 and a half years. For example, when I was a painting contractor years ago, I'm pretty good at painting a room. Should I be painting a room? That's that middle column, right? Just because we have skills or we know how to do something, you're kind of indifferent, and we do a lot of activities in that column. Are they the highest and best use of your time? Could you be doing something better? So that is a little tricky. But I think what happens too is that, this 80-20 rule, I was really going for the 4% rule. And I'm not talking about the 4% rule of live off my assets and flying down like you hear wealth advisors. I'm talking about the 4% rule of the 80-20 of the 80-20, of the 20% of the 20%, which is the top 4% of activities that I could be doing. So I started really focusing on that. And, I wasn't really born to be a multi-billion-dollar fund manager. That wasn't really necessarily my skill set. The company did very well. I brought it to a particular place, but I don't know that I was the person to take it to the next level. And I think it was very prudent to do that. And I think, I'm not saying it's easy, because it's a struggle for a lot of entrepreneurs and CEOs to say, hey, maybe I'm in the way. Maybe I need to rethink how I'm doing things. So actually, it's been working out very well for me. I've gotten a lot of time back. I'm doing more of what I really enjoy doing. I don't have the same level of commitments, and I can actually look at doing some things that I haven't been able to do for a long time. So I was able to do some traveling and talking with investors, which I really enjoy. I like meeting and networking with folks, and so I'm able to do a lot of the things that I wasn't able to do in the CEO role. And that CEO role just kept getting busier and busier. So, sometimes we end up doing a lot of things, but we're not really good at a lot of them, especially as they grow and scale, right? So the next thing you know, am I the best person? Here's a perfect example. When we first started the company, I had done a little marketing because I was a realtor, right? They go, well, you know something about marketing. You do marketing. Well, now you're fast approaching $1 billion fund. Are you the marketing guy for $1 billion fund? The answer is no. So like, who are we kidding, right? Like, that's just one example of the point I'm making. So yeah, sometimes we become the weakest link later as the business scales. Is kind of what I'm getting at, right? But I think it's a good exercise of knowing yourself, knowing what you're best at, bringing in the best of what you're not best at. Like if say you wanted me to do operations, or you wanted me to do process, or you wanted me to do IT, I'm your worst guy for that, right? So, but I'm not afraid to admit that, right? So some of us like to try to do everything.
Well, thanks for sharing that interesting processes. And I think that all entrepreneurs are struggling with that very concept there of what should I be doing? What should someone else actually be doing? And who can do it better? We all have those egos, and we think that we're the one to be doing that job because, well, nobody else can do it quite as well as we can. But we just become then a jack of all trades and master of none. And like you said, we get in our own way by doing that. Well, Dave, what does your company do, and what is your strategy? You had mentioned that you are into mortgages more so than into to properties themselves. So talk to us about that and the differences actually between holding mortgages and holding properties.
Yeah, so we have investment vehicles for high net worth investors that is truly passive. I think the one thing that we bring to the table is that we're well diversified, right? So we have a lot of assets, especially mortgages. We're in all 50 states. We do tend to have more mortgages where the population is, for example, which makes sense, right? So you'll have a lot of assets in California and Florida, Texas, New York, that kind of thing, Pennsylvania. If you asked us, do we have a lot of assets in Wyoming? No, there's not a lot of people in Wyoming. So that's one piece. And we buy a lot of distressed assets. So we buy a lot from other funds. We actually have a JV partner on the West Coast who has a trade desk in New York. So we get access to a lot of product. And really what we do is we're the private equity piece. We marry the private equity with some institutional capital, and then we go out and make multiple trades over a period of time. So we get to a critical mass of I'd say in the $200 to $300 million range. And then we'll go to securitization, which is really a fancy way of saying we refinance a pool of mortgages, get better terms. And then that special purpose vehicle will wind down those assets. And then we go and do that again. And then we go do it again, that kind of thing. So we'll get to a point where we'll buy, a couple $100 million in assets and then wind that down and then go do it again. Then we also have commercial notes that we invest in. And we do that primarily to regulate our capital. So we invest in a lot of fix and flip loans. We own 20% of a company that originates hard money loans, fix and flip loans in 45 states. And we have first right of refusal to buy those loans because we're the facility for their lending. So in other words, we give them the capital to lend out. When they originate a loan, we have the first right to buy that loan. And then a lot of times what we'll do is as we're raising money, we can park our money in those types of notes. And then if we need capital to make a note purchase, a pool of mortgages, for example, or we want to make a commercial real estate transaction, we can put those loans on our line of credit, recapitalize very quickly, or we can even sell them on the secondary market, that kind of thing. So we're a lot more liquid than most real estate funds. So a lot of our money is moving, whereas a commercial real estate fund is typically parking money and waiting kind of thing. Then we do have some commercial real estate, primarily multifamily. We are doing more affordable housing. We like the tax advantages, and it's a unique targeted area of the multifamily business. We kind of like the affordable housing space. We have done some value add as well. It's probably makes up about 15 to 20% of our portfolio. The non-performing mortgages is probably about 75% of the portfolio. And then those commercial mortgages are 5-6%, that type of thing. And that's really to regulate capital, and we can reduce our cash drag that way. So we have these three verticals, so to speak, and that's how we manage the capital. We also have a CIO who's an economist. So we'll get an investment thesis for the year and for the quarter. And then we have an investment committee, and then we allocate accordingly, partly what the markets are doing. And then we allocate and adjust accordingly, like that, how much we deploy into any one vertical at a given point in time. The one advantage of the non-performing loan business, though, is that it does tend to take off during recessionary times and post-recession. So that is something that's unique in a fund that invests in real estate-backed assets. So we have means to make money in kind of in all markets. So,
enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes.
Well, in terms of the investor, how liquid is a person's investment with your company?
So we do have a couple of fund options. We do have a 6-month option, a 1-year option, a 3-year option, and they also have the choice of compounding or not. And we also have like what I would call like a sidecar fund if someone was coming from a qualified plan where there's no UBIT, because we do utilize leverage, and normally you would experience UBIT. So we have a structure that doesn't have any UBIT tied to it. So, they're kind of the offerings that we have for the investors. So yeah, people will do combinations of those based on what they think their liquidity needs are. Typically, it's a 90-day notice type thing as they're approaching maturity, if they want their capital back or if they want to go into the next offering, that type of thing. And, we've been doing this since 2007. So we have a pretty good, solid track record since then. We've never missed payments, never not paid on redemption, that kind of thing. Even all through COVID, we've paid our pref. We've never missed. So, it says a lot. Not too many. We're in our 16th year, right? So I don't know that there's too many things on Wall Street that have paid for 16 years straight. So
Probably not. Well, what are the disadvantages to investing in a fund as opposed to investing in a property?
No, that's a great point. Like today, we don't have anything that's really tax advantaged, like say a syndication would be. Now we are considering doing some stuff in that area where whether it's through direct investing or having a tax advantaged option. So that's one weakness, but we tend to fill that time frame between that 6-month to 3-year term, whereas a lot of commercial real estate syndications and funds, for example, may be longer term. They may be 3 to 5 years or longer in some cases. So we're kind of filling a different time frame for folks, just like some funds are a year or less, right? So I think we fill a position there in between, because we are a little more liquid. We're not as long term. We're well diversified. When someone comes in our fund, they're instantly diversified with a relatively smaller amount of capital, right, than they would be, trying to invest in mortgages by themselves, right? All your risk would be in one mortgage. I used to say years ago, your biggest risk in the mortgage business is you don't have enough capital deployed. You are the biggest risk, is what I used to tell people. Yeah, you're because of the nature of the business. Like if you're Bank of America, they're invested in all the states with millions and millions of dollars, right? So they're so well diversified, but it's because of the amount of capital they have deployed. The individual, it's hard to do that, right? As a one-off person, you tend to have all your risk. Even when I was I was telling the story of when I was an investor with 40 units, they were all in one county though, and if you think about it, it's probably riskier than you think in some ways, where the strike of a pen by a legislator or whatever, or landlord tenant law, or who knows what, could change the dynamic. You'll even see housing inspectors start to mimic the housing inspector from the next town over, right? And next thing you know, the rules of the game change from when you started your business, So I think there's an advantage to some of that diversification, but yes, everything has advantages and disadvantages, I think, But I think
Absolutely.
there's a place for our fund for a lot of investors, though.
What is your minimum investment?
Our minimum in the lowest fund is 50,000. I mean, in the highest fund is 50,000, and the lowest fund is 25,000. Said that
Okay.
wrong.
Do you require accreditation?
Yes, yes, we do. We've been fortunate. We have a very large following and audience over the years. So yes, that is one of the advantages that we do have is we can raise a lot of capital quickly of private equity, and that's served us well over the years.
Well, you've sort of alluded to this, but be a little bit more specific here. And that is, how has your company grown and evolved over the last 16 years? Where did you begin?
Believe it or not, in the beginning, it was with 4 mortgages, and we were working with delinquent second mortgages. And it was because you could position yourself into a deal with a small amount of capital. And out of those first 4 loans we bought, one was a home run, one was a grand slam, and 2 we lost money on. So if we had only bought 2 loans and they were the 2 that lost money, we probably wouldn't be talking today.
Well, so how did you grow from that particular?
It's funny you say that. I remember having goals back then where our goal was to raise $50,000 in a month, which today it's very common for us to be at 25, 30 million a month in capital raise. So you can see it's changed dramatically. And then we had no leverage back then. So that banks didn't really look favorably upon junior liens. And what happened for us is we used to actually make higher returns of junior liens. We just couldn't get enough volume of them as we grew. So we couldn't really scale the supply. So then we morphed into first mortgages, and then you can leverage first mortgages much better. They're more bankable, so to speak. Just like commercial real estate's more bankable than some other things, right? So it all comes back to this leverage component that I was talking about earlier. It is critical that leverage does work both ways. Don't take it the wrong way. There can be risk in the way you utilize leverage, but I think that's something that we probably could have utilized. I wish I knew what I know now, right? It's easy to hindsight's always 2020, but it would have been probably wise to have gotten into first mortgages or the commercial real estate sooner. Prior to starting PPR, though, that was one of the things I did. I was raising capital for commercial real estate, for mobile home parks, storage centers. We were doing some commercial office condo construction and things like that. But we also had a crash, and there were some good stories and bad stories where some of them didn't work out, right? That happens. But yeah, no, I think there is a lot of diversification in this space, and I think there's a lot of opportunity. And it's something that's unique that is to our funds that some of the other funds don't have. So a lot of people left the mortgage space after Dodd-Frank, for example, because the regulatory environment got so strict. So we are well positioned, for example, if there is a future recession, because we're kind of locked and loaded, ready to go. Whereas there's not as much competition as there once was.
Well, tell us how we can invest with you.
Yeah, sure. It's pretty simple. You could go to our website, which is PPR Capital Management. It's spelled mgmt.com. You can go there and schedule an appointment with our investor relations team, or you can actually start to fill out an application and invest directly through the platform. Yeah, and you can ask a question or set an appointment to talk to someone, because I'm a firm believer in a personal touch. I believe that, these are often significant investments for folks. I think you should have the ability to pick up the phone and talk to a human. I think that's important. And this is some of that we've kind of lost along the way in recent years. It feels like, I know I struggle with it myself. Sometimes it's very difficult to get your question answered or get a hold of someone, that kind of things.
Well, I think probably most of our viewers and listeners understand the process of leveraging a property. But you had mentioned that you leverage mortgages. Could you explain the leveraging process for mortgages and notes?
It's very similar. So if you think about, a lot of times folks will say, well, how can your funds pay such a good return, for example? And I think part of what they may or may not realize is that we're taking that private equity and marrying it with institutional capital. And then you get a blended rate and it lowers your overall cost of capital. And then the other thing is if we purchase a pool of non-performing mortgages and we start to get those assets reperforming, and then we go to securitization, we're refinancing to even better terms, right? So there's always this utilization of capital. I don't want to say, gymnastics or whatever. I don't mean it in a negative way, but you're constantly always looking at your capital stack and your structure and how can you improve things along this, I'll call it an assembly line, so to speak. But it's very similar to real estate as well. It's just a lot of people might not be as familiar with it. I know I often joke with people that, hey, we're all in the note business. We're all in this, when I say notes, I'm usually meaning notes and mortgages that are secured by real estate. But the note business, which is really just a promise to pay, is all around us, right? There's so much debt. There's credit card debt, auto debt, medical debt, student loan debt, goes on and on. I just happen to be in a vertical of debt that's backed by real estate. But I think there's all kinds of debt everywhere. And we're all in the game, whether we want to realize we are. So if you're in the room you're sitting in and you look around, just about everything around you has been financed. The property, even the land sometimes, the furniture, your clothes, everything's been financed to a business, somewhere along the line. Now, we may just not be paying attention to it, and we may not be thinking about investing in debt, so to speak, or, I can buy debt at a discount or something like that. It's just, we're just not paying attention. But these industries, and this is trillions of dollars in these verticals, right? So it's not like, I kind of tell people we're all in the note business, whether you're participating or not, it's going on around you. And, we just introduced the idea, instead of writing a check to a bank or a credit card company, that you could be receiving the check, right? So it's just a different way of looking at it.
Well, Dave, it's been a pleasure having you. Very enlightening conversation. Thanks for being our guest today.
My pleasure. Thank you.
Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off, passive real estate investments, then you'll want to immediately go to stevetalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to stevetalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.